Okay, so I'm going to show you guys how to compute the Wacc and how to do the sensitivity analysis based on different Wacc. So in order to compute Wacc, first we need to find out all those inputs from different source. So the first inputs we need is the market value of that. So you could either find the market value of that on Yahoo Finance or by looking the company's annual report. Basically, the market value of that is just the book value of total debt. The next thing we need is the market value of equity. So the market value of equity is computed by using the price multiply the number of share of outstanding. So for the price, you could find the price on different security website. You just use the most current closing price. And for the number of share of outstanding, you could find out the number by using the same website or on the company's quarterly report. So after we found out the market value of that, we need to compute the cost of equity and the cost of debt. So in order to compute the cost of equity, we need to find out three more inputs. So the first input we want to find out is beta. So beta is a way to measure the sensitivity for the company between the company and the market. So beta of 1 means that the company move exactly the same with the market. And if a company has a beta below 1, that means the company are less risky than the market. However, it has less return than the market. So you could find out beta on different source. For example, we found out beta on value line here, but also you could use Morningstar, Bloomberg to find out beta. However, different source you use would give you a different beta. So that's why we need to run sensitivity analysis in the end. However, the beta among different sources would not vary that much. So the second input we need is a risk-free rate. So we typically use either 10-year or 30-year T-bill rate to represent the risk-free rate because we want to find out the company's long-term value. Therefore, using a long-term risk-free rate is more is better. So here we found out the risk-free rate by using on the treasury.gov, and it's 2.38%. And the third input to compute the cost of equity is a market return. Sorry. So in order to find out market return, you could go to the Bloomberg terminal and find the average 5 years of SPX return, which represents S&P 500. The number will typically vary from 8% to 11%, depending on which time frame you are using. So it's also that's why it's also important why we want to run a sensitivity analysis in the end. So after we have all three inputs, we can compute the cost of equity, which write E here, by using the CAPM model. So basically that is just using the risk-free rate as a beta times the market risk premium. Market risk premium equals the return of market, subtract the risk-free rate. So yeah, so here we have a cost of equity of 7.91%. And after the cost of equity, we also need the cost of debt. So Again, there are many different ways to compute the cost of debt. Here we found out the cost of debt on the company's 10K, which I think is one of the easiest way to compute the cost of debt. And this number is actually more accurate because that's computed by the company, by the insiders. But if you could not find these numbers, you could always using the company's rating to compute the cost of that. So for example, if the company rating is AAA, you could find out its bond spread by using different website. Let's say its bond spread is about 0.5%. And then you add this bond spread to the risk-free rate, then you could get cost of debt. But if you cannot find this bond rating here, you could always using the interest expense divided by the total debt. So by using interest rate expense divided by the total debt is also a way to compute the cost of debt. So after we get these two numbers and all the inputs here, we can compute the Wacc. Okay. Oh, so the market value of that just we already found, and we also found the market value of equity, and then as I just mentioned before, the cost of that is 3.7%, and the cost of equity we get is 7.91%. And then we want to find out the weight of debt and the weight of equity. This is just basically the capital structure of the company. So you use the weight, you use the market value of debt divided by the total capital of the company. So you could find out the weight of debt, and you use 1 to subtract that number. You could find out the weight of equity. So also you need to find out the tax rate, because when we compute the Wacc by using the cost of debt, we want to take the tax out. So that's the final equation. We use the cost of equity times the weight of the equity plus the cost of debt times the weight of debt, and we also want to time the 1 minus the tax rate, as I mentioned before, because we want to take the tax out. Okay, so after we get however, the Wacc is here might not be that accurate, because as I mentioned before, we have like different sorts of beta. We have different risk market return, and we also have different way to compute the cost of debt. So in order to give us a more confident number, we want to do some sensitivity analysis. So here I made kind of an example about how to do a sensitivity analysis by using different Wacc. So let's say we have we already compute the future value of the stock, which is $100, and in the next 9 years, and then we want to discount the future value to the present value, and by using the Wacc, so just $100 divided by the 1 plus the Wacc raised to the power of 9. So then we can find out it's the $100 present value. And then we want to run a sensitivity analysis based on different discount rate to compute the different present value. So here I already have a range of Wacc from 6% to 9%, and then we want to put the present value here because that's the number we want to get, right? Based on different cost of based on different Wacc. So we select this range, go to data here, and then select what if analysis, and then go to data table, and we want to link the column input cell to the Wacc. Basically, that means we want to change this number here. So, and then we click OK. So by doing that, we can have a range of number from $60 to $59, depending on different WACC it gets. And also, we can from this chart, from this table, we can see that as the WACC increase, the stock price will be decreased because the cost of raising capital is more expensive. Therefore, the fair value of the stock of the company will be decreased. And after you get this range of number, you could also create a football field chart, which can give you audience and you a really clear image about the fair value of the company. So that's all. Thank you.